Hello, everyone. Welcome to Founders Marketing Compass. My name is Etgar Shpivak. With my experience as a co-founder and as a marketer, I'm interviewing founders and investors to learn how to build healthy, lasting relationships between startup founders and their marketing team. Today, I'm hosting a serial founder who became an early stage investor with over 140 investments. Avishai Sam Bitton. Hello, Avishai. Thank you so much for taking the time to participate in this podcast.
My pleasure, Edgar. How are you doing today?
I'm doing great. Happy. Before we will start to dive into our questions, if you can tell me a bit about yourself and your journey.
I started in the tech scene around 14 years ago. I did a stunt, kind of a growth hacking guerrilla marketing stunt for myself to get my first job. I ran Google ads, around $100 worth of Google ads to 500,000 impressions by just advertising on the names of CEOs that I wanted to work for. From there, I worked in a startup as employee number one, then later founded my first startup with my co-founder. I didn't see that company through all the way till the end, but my talented co-founder managed to exit that company, and that's kind of my first exit on the belt of a company that I started. And my second business, which is still running, is a bootstrap media company. And I'm now enjoying my time as a person leading all growth and marketing in one of my investments in my portfolio, which is HVAC. And we're basically helping entrepreneurs build their business. Everything has kind of been around entrepreneurial spirit for the past 14, 15 years.
This is amazing, and happy to hear a bit more about your investment strategy. Angel
investing was something that I didn't plan on doing. It the first time it happened, it was completely by mistake. I was hearing about friends that were doing an investment in a company called Dialogue, and it seemed that I was intrigued at the time more with the founder, less with the startup. When I'm looking back at it, and I saw a founder that basically would not stop at anything. They would break any wall, break any glass ceiling to succeed. And I wanted to put money behind that founder. I can't explain. It was kind of a thing that I just felt I had to do. And I did that. And that was my first investment. I wrote a check of almost 6 figures. And I learned that on the cap table, there were other angel investors who have done multiple other investments. And they started introducing me to their portfolio companies and what investments they did. And from that one startup, I found myself going down a rabbit hole of learning about how to create deal flow, how to meet more founders, how to put more early stage checks in. And I now have a friend who, me and him, every deal that comes across the table, we share with each other. He's with me on that cap table of my first investment. I have multiple friends that I know according to what their preference is. I share with them deals, they share with me. And the investment strategy that kind of got built out of this kind of origin story of how I became an angel investor is that I mostly invest in founders that I believe in them, not necessarily the company that they're building, not necessarily the space, but I believe that they will find a way. And if you need just one example to how that investment strategy looks like in today's time, because we're recording towards the end of July of 2024, one of my portfolio companies just finished a very aggressive pivot, company called V. And the founder there, she did an amazing job of taking the company from one direction to the other direction. And that is what my investment thesis is really built about, how startup founders can be more powerful than a lot of forces of industries and markets and appetite of investments. They can move a company to a successful trajectory by just their will and force and attitude. So my whole investment thesis is around which founders can move mountains by just their ability that they have inside. It's not a skill, it's a personality trait, it's an X factor that you can't teach.
In your opinion, what makes a startup's marketing team successful?
I think that what makes a startup's marketing team successful is the ability to connect to the revenue goals. If a startup is letting the marketing team without revenue goals run, then usually there will be a lot of disappointments from the team. I feel that modern marketing should be completely 100% be aimed at revenue KPIs, because the way companies were built in the past, that's not going to happen now, and it's going to take a lot of time if it's going to happen again in the future. In the past, VCs would put money, companies would grow without very hard KPIs of profitability or good unit economics. And they would just raise and raise and raise. In today's world, if you're building a go-to-market strategy, you better have a roadmap into better unit economics, better profitability, shorter payback periods, higher LTV divided by CAC. These are things that if you're not building towards, you will have a bad time when it comes to marketing and go-to-market, not only in the fundraising, but also in the day-to-day of managing the cash flow, keeping a low burn. It is extremely hard to grow aggressively, fast, and healthy. And it all starts with the initial mindset and the infrastructure. If both are skipped, companies can find themselves in very problematic situations in the round A, round B stage where they don't have the necessary infrastructure to keep growing without diluting the company very aggressively.
If I would elaborate on this specific question, and you talk about consistent approach toward the revenue, how do you handle when the company going into round like later stage, round A, they already have their $5 million ARR? How do you handle the issue of your portfolio company come and say, now we want to invest in the brand? And one of the problem with investing in brand marketing is around the fact that you will see the return on results a year from now, 6 months from now, and not immediately. Because many cases, founders, especially in the early stage, they're living from round to round, from the pre-seed to seed, from the seed to A, and now they need to go and to make a heavy investment on a brand marketing that will serve them 1 year, 2 years from now. How do you see this as an investor who actually need to be part of this check?
I'll divide it into two. First of all, I don't think companies really have to invest heavily in brand in the beginning because the amount of resources you have to invest in brand in the beginning are not high, and it's not really going to be as memorable as you think. I think that the best way to invest in a brand is actually the way that doesn't cost anything. And a company can start building in public and doing LinkedIn content and document the whole building the company experience and use the way they see the world. The founders can use basically their mantras to kind of create a brand around the company for what it stands for what it wants to try to do. If a startup has to survive because it's a startup, that is the definition. A business is trying to find some form of way to reach profitability. It has to be revenue minded first. And even if things might pan out in a year from now or 2 years from now in terms of the unit economics that the company wants to reach to, the best time to start doing demand generation with aiming to get great unit economics, it was yesterday or today. And every moment the company postpones their journey into the world which was unsexy until a few years from now. There used to be a joke on the show Silicon Valley, never make revenue. Like you should always just create a hype, but never make revenue. The more companies are postponing now the making the revenue portion, the more they're postponing things like product market fit. Because how can you have product market fit without the proof of revenue? How can you have even segment market fit without the proof of revenue? The only thing a company can do without trying to create profitable pipe is maybe find problem market fit. And that is still in the 0 stage and not at the 1 stage. And brand doesn't help in either one of those things in terms of finding the fit. You can have product market fit without having a brand. And it doesn't help moving stages from 0 to 1 or 1 to 10. If I had to choose the earliest moment where a company can start doing brand is when the company already sees a path to exit or IPO. Before that, brand should be at most third priority in a company. Like it never could be first or second.
What marketing metrics are the most important for you?
I want to see what is the average order value, average contract value that is coming in from each client. So we can reach the LTV divided by CAC metric, because the CAC metric on its own is not interesting. You can have, for example, paid subscribers to this podcast right now. Let's say we're productizing it and putting a paywall. If your CAC is $100 or $10, those numbers don't really matter unless we know how much we're actually bringing in. So I want to see very quickly how much money is the company bringing in from each client. And from understanding the LTV divided by CAC, I understand what is the potential payback period right now that we have. What is the future potential payback period? And you can decide to scale a company now or later in time according to the payback period in order to match some kind of agenda, like I want a low burn rate, I want to actually grow without VC funds. When I'm looking at marketing metrics, I want to see that a company understands all their metrics, which is how much clients do we want to bring? What is the average contract value? How does that translate to how much revenue we want to bring? How much are we willing to pay for each customer? How long do we want our payback period to be? And how the LTV divided by CAC should look like. And if a company knows all those numbers, then I can look at them from an investment hat and say, okay, I can get behind them. They know what they're doing. Those numbers, sometimes you can talk to founders and they don't align. If you change one of the numbers, they'll change it for all. If somebody's giving you numbers and they don't align with each other, usually it's a red flag to not invest in that moment because it means that they're not 100% closed on their go-to-market. But it can be solved. They can bring someone who understands this, and in a day's work, those numbers can be aligned. So it's all about having, I want to say, the mindfulness to know those numbers in order to do go-to-market successfully. Those are the metrics I'm looking for. And none of them can live in a bubble. They're all intertwined with each other. They could be measured siloed, but I want to see the full picture of all these metrics and not even skip one of them.
By the way, this is something very interesting that I see repeatedly in this podcast that investors that I really appreciate. They said they can live with the numbers, but they can't live with founders who don't have full certainty of what they're doing. We're in a situation when we look at Facebook and Google that dominate like 50 to 100% in this market. When you run ads on those platforms, the ad platform taking you into a very blended approach. I mean, give me all your data and I will do my best. And one of the problems is this, is as a market, it's become really hard to distinguish between how much of this CAC is actually incremental, actually focusing on new clients, and how much of them is actually trimming your low-hanging fruit. How do you, as an investor, handle this problem?
One of the best ways to handle this issue is by working with founders who are very conservative in their nature. And this is something that actually changed a bit in my investing thesis, because in the beginning, I wanted the founders who are very out there and playing attack and raising more money. And they knew how to basically play the startup game in many senses. Now, when I meet people who build plans that look very pessimistic, I know that their attribution models will also be very pessimistic, because from a personality trait of a startup founder, the only thing that beats someone who is extremely ambitious and wants to reach the stars is someone who's ambitious, wants to reach the stars, and is paranoid in the same time. Because startup is all about surviving. And if you can find someone who wants to move the company forward very aggressively while being paranoid, you kind of enjoy the best of both worlds, because they're moving the company aggressively forward based on what they understand and know in a kind of a worst case scenario glasses that they have on them. So for example, if the company is still young, they're assuming a churn rate that is higher than anybody in the industry. If the company has an amazing CAC right now, they're assuming that the CAC will only grow higher as they bring more people in. If they have a good average contract value right now, they're assuming it's only going to be lower because the first customers are always the customers that it's easier to convert because the founders were focused on them. So time after time, they convince themselves that what they're doing next is actually going to be harder. So when they have that mindset, they build metrics from that mindset and they log in data from that mindset, and then they represent data from that mindset. Worst case scenario, the board will see numbers that are actually less impressive than what they are in real life. And it's always an option to later go back, fix, and tell the board that, what, actually good news, we're actually in a better situation than what we expected. It's always great to delight the board with, hey, we made a mistake and it's actually more positive, than, hey, we made a mistake and it's actually more negative. It will show board members and investors that there is a very responsible founder at the helm, making sure that the company's survivability percentages, the chances of the company surviving, are going to be very high.
So I assume you send your portfolio companies the catch-22? With the fact that you're paranoid, it doesn't mean that no one is chasing you.
I think Catch-22 is the interesting book for founders from multiple directions. It's not just about the paranoia of Yasurian. I think it's also from, if you read the segments of how the syndicate works, think startups can learn a lot from basically the give and take and how to navigate in a world that there are so many ways to move forward and get to what you want and to partner with who you want and to get the clients that you're looking for. And the straight line is most often the hardest line to take. And a lot of the squiggly lines and the things that seem that they're very far-fetched from how you should do things are sometimes the easier way. There's a reason why growth hacking, which is a buzzword that's been thrown around for the past 15 years, is still a prominent buzzword because it's still how companies break glass ceilings and break walls to continue to develop better go-to-market strategies, more profitable ones, get strategic clients. You just mentioned the book, and I can totally recommend it for founders. I think it has more than one lesson for a startup founder in that book, if I'm not mistaken. Probably going to be 100 years old in a few years. I think it's a 60 or 70 years old book, if I'm not mistaken.
It's 61.
61. So it shows that there's timeless lessons in the from different times in life that could be applied to a startup now and in the future.
What's the biggest marketing mistakes that you're seeing startup do?
Hire marketers. This is going to upset many startups, but 99% of startups will hire a marketing manager, head of marketing, director of marketing, VP of marketing the first time. They're going to be extremely disappointed with them. Mostly because there's a flaw in how marketing works. In many different segments like R&D or product, people usually vertically specialize in something and they move across the ranks and they learn how to be managers with that specialization. Marketing is very multidisciplinary. There's SEO, there's content marketing, there's performance marketing, there's events, there's partnerships, affiliates. All these things are under the marketing umbrella, and there's some that I forgot. And a lot of times people move into be team leaders and managers and marketing teams or directors or heads or VPs or C whatever, and they only learned one or one and a half of the disciplinaries. And here's what happens. They start building teams, and all the talent under them understands that the person managing me has no idea what marketing is, because each one from their disciplinary is like, I know SEO very well, but my manager knows nothing about it. I know performance marketing very well, but my manager knows nothing about it. And that goes on and on in so many companies. And what happens is that a lot of startups will make the mistake of building a marketing team instead of building a revenue growth team, which is bring extremely successful ICs, the unhireable kind, to do the work that is needed in order to generate revenue. So for example, in the world of demand creation, bring the best individual contributor you can to create demand on a platform like Meta, for example. And it doesn't matter if you're in B2C, B2B, or B2E, Meta actually will work on more platforms than not. Like it can work on cybersecurity, it can work on things that a lot of people don't believe it can work on. So that's in demand creation. In demand capture, bring the best IC possible to do Google. Don't bring head of marketing or VP of marketing or a CMO who will later look to bring people that they don't understand if they're good or not. Don't bring someone who's taking so much of your OPEX and your that you can actually use that money that you're paying for a manager. What's to manage in a startup? You have to create funnels and to be as omni-channel as possible and profitable as possible in your budget, in your burn budget, and a manager takes so much of that budget away. The marketing leaders who like to work with their hands, after they taste the management suite, they want to manage people who do things. And if you think about the entrepreneurship landscape, especially in the startup oasis, which is Israel, where me and you know a lot of people, there are no CMOs going to be startup founders because that requires manual labor to work to do 0 to 1. There are no CMOs who are angel investors because they're so disconnected from this world of how to build a startup from survivability mode to profitability mode. And there's almost no CMO who wants revenue as their KPI. So the biggest mistake that startups do is that they bring in marketers too early. There are growth people, there are former solopreneurs, there are a lot of different type of personalities that I would put in charge of marketing before I'd put a marketer. And I know some companies right now who tell me that the best CMO they ever had was the former CTO. They moved the CTO to CMO suite. You have companies like SimilarWeb who now took their VP product, they put in a CMO. Great move. You have companies like Yotpo, took somebody who's amazing in operations, put him in CMO. Nobody wants a marketer in the CMO suite. It's a net loss for the company. And I know this is going to upset many marketers, but marketers need to reinvent themselves in order to be helpful for startups. They're right now, at best, helpful for very large corporations who already have set of infrastructure that has put them to be well placed to continue to succeed and grow. But what about the companies not growing? And in 2025, there's going to be a lot of disruption. And SDRs and BDRs are going to have to move from the sales suite into the marketing suite. If the CMOs of tomorrow don't understand how to build the infrastructure needed for them to work with their hands smarter with AI and automation, how will a company move into the future? I'll just give you cybersecurity as one space where this is very prominent. All the marketers are from events and events coordination, and at best do LinkedIn and Google. That's a huge loss for a company to bring in a marketer in there instead of somebody who can aggressively grow a company. So I know I went here on a whole rant, but it applies to almost every startup. Don't hire a marketer as the first hire to do a go-to-market. There are people who are with no knowledge in brands, have no idea what a good design looks like, but they know how to bring people down the funnel, and they know how to bring qualified people down the funnel. And they have a way of doing it, which I'm not great at explaining, and they're not great at explaining. But just let them do their shit.
Is there a startup whose marketing approach impressed you?
Yes. Monday.com is a great example. They had amazing ICs. They had people like Rodem Shai and Liron Katsav doing Meta and YouTube. And to my knowledge, never had a CMO. Co-CEOs were the real bosses of the marketing team, working with KPIs around payback period, connecting everything to their big brain. I ran for a while for the Pulse, which turned into Monday.com ads. And I saw inside that account the level of professionalism that they have. Like, extremely dedicated team of ICs that ran based on the data to make data-driven decisions to just grow the company. And there are other people who've worked there, I'm sure. I don't remember all the names. I don't know all the names. Almost anybody who came into that department could not BS anyone because there is no CMO to BS. You have to BS the co-CEOs, which is extremely difficult when you have two such amazing operators like the ones running that company.
What's the one mistake that founders commonly do when they work with their marketing team?
I think almost every founder in the beginning works with their marketing team based on all kinds of assumptions that either they had pre-existing from their former companies, right? A lot of the founders are engineers or product people who thought that the marketing function was to do one thing, but they worked with them in a bigger company, not at a startup. So there's this mismatch sometimes. And those previous notions also come from the board and investors. Investors a lot of times will push the founders, they should hire a first marketing person. But when I sit with general partners for meetings, on coffee, for dinner, and I say to them, I apologize, but I don't know many good marketing people in the industry. I don't think there's even good CMOs in Israel. I'm a lot of times waiting for them to start arguing with me, and they say, you don't have to apologize. That's actually right. Like some of the very rare good cases of a good Israeli CMO, they're actually living abroad. Growth is something that Israel is amazing at. Marketing, not so much. And you'll see that the most successful big companies, they grew on top of performance. The Next Insurance of the world, and you have Monday, which I talked about prior, and you have other companies who are on the other end very sales-led. And the way you get to that sales-led is making that set of mistakes in the beginning of working with your marketing in the early days about things that are not revenue oriented, and you're just leaving the marketing team without revenue goals. You end up sales-led like that. You make the CRO look better than your CMO or your VP sales look better than the VP marketing just based on the fact that you set one team to do revenue and the other one not. So if you have a marketing team and you're already working with them, if they don't have revenue KPIs, you might be better off without.
How do you, as an investor, define a good CMO?
I think a good CMO understands that their success is a lot going to be based on their ability to use data and to find real needle-moving opportunities for a startup. Startups usually have, at any given moment, one or maybe two great ways to scale revenue. And any action that the CMO does not do in order to fulfill that opportunity is an action that is wasted. Only in later stages, there could be what I would call satellite actions that support and build and give other things. But in the beginning, until a company doesn't have a working, well-oiled machine to scale customer acquisition, scale, increasing the annual revenue, until that's not built, that's all a CMO should focus on.
What's the most surprising lesson that you learned as an investor?
And this is my surprising lesson. No matter how many startups you see and no matter how many startups you invest in, you still don't know anything. I thought that by investing in many startups, it would give me the experience to know more. And the more I dealt with the different investment rounds and the founders and their challenges and seeing the companies grow, really the whole experience from the minute of deciding to be an investor all the way to what's happening now in real time, you understand that you really don't know anything. And I now come very humble to the next investment that I'm going to do, knowing that whatever I knew a day before I became an angel investor is as good as what I know now. There was a gut feeling that might work out, might not. I can't be I'm a expert in every industry. I don't have Röntgen eyes. I don't have like X-ray eyes to figure out the inner working of each and every founder. I can make assumptions. I don't know where the market is going. I don't know what is going to be the investment appetite. And the only thing I can say that I am really enjoying, although the surprise, I don't know anything about angel investing, I feel that as a professional at least, or as an entrepreneur, I learned a lot, and that balances out the surprising lesson of not knowing anything as an investor, but I think I learned a lot. So
I know that a lot of startup founders hear us, and one of the questions that I got like actually reactions on were like, what's the common misconception about running a startup that you would like?
I think the most common misconception about running a startup is that it's easier to run a company just because you're getting funding. I have spent a lot of time in VC backed, and I've spent a lot of time in bootstrap. And I think that there's a mental toll that VC backed brings with it that uncomparable to any type of business you build. Because when your startup isn't doing great and you get diluted and you have a board, that if you're not doing great, the board might be aggressive. You might be also doing great and the board might be aggressive. I know founders who have been basically struggling, even though they had millions of dollars of cash in the bank. And I think that's the biggest misconception. Just because a company has millions of dollars doesn't mean that the founders are sitting legs up, margarita in their hand. When you see a $40 million investment in a company, remember, somebody has to bring a return on that investment. And the level of stress that comes out of raising $100 million is extremely high. You're an ambitious person that you're not doing it for the money and you're not doing it for the fame and you're looking to solve a big problem. Raising $100 million brings immense amount of pressure because you have to give the investors back a multiple. How do you give back a multiple on $100 million? Well, you better build $1 billion company in the worst case.
If it give your younger self advice at the start of your journey?
I think that my younger self should have learned more about the legal aspects. I think I signed a lot of contracts in kind of a rushed way. I think I didn't negotiate enough on all kinds of terms. Today, I don't move without having the terms that I feel comfortable with. I believe that at this stage, when I'm not young, I'm older, I'm confident, I've had some success under me. I think at this stage, I understand the power of having very good deals in place from the get-go and not having deals that put you in a disadvantage later surprise you. I would probably do my co-founder agreement different in my first startup. I would do different partnership agreements in my second one. I would do different types of investments, probably some angel investments that I wouldn't get into, just based on my legal kind of, I want to say, beginner mindset that I had in the past. Today, I feel that I'm in the place where I can call up my younger self and say, you should really understand the repercussions or the potential repercussions of everything you saw.
By the way, I think that on this one, I would definitely take you I think there are a lot of great books. For example, there is the book Venture Deals. This is a dictionary for how investment and how investors think, and we definitely recommend on this. And now for the last questions that I'm ending each episode. Which question did I need to ask you, but I didn't?
I think the question you needed to ask is, when should founders decide to leave the business? Because there's this notion that a founder is there forever, but it shouldn't. When should a founder remove themselves from the startup? And the answer to that is whenever the founder believes that they can't bring the level of impact that they would like to. Because it's mentally draining to want to help your own startup, but not being able. And I think that any founder who believes that if somebody else can come in from the outside as a hire and do a better job at their role, should decide to move, first of all, to move aside from their role, and then to figure out if there's room for them in the startup. I think removing a founder from a startup is always like, oh, that's bad news for the startup, right? Like something's bad's happening in the startup. It has that stigma, and I don't think it should have. I think it's very responsible when a co-founder removes themselves on their own terms, or at least with terms that maybe they agreed with the board to remove themselves. I think it's very responsible to say, I know I founded this company, but there's someone that can take my role and do a much better job.
Avishai, I had a great time recording this episode, and thank you so much.
Thank you, Etgar. I had also a great time, and I am looking forward to do more content with you again in the future, because this was a really great conversation, a really fun one, and I think a very educating one. I think a lot of future startup founders and future angel investors have here a lot of nugget wisdoms that they might some agree with them, might not, but it will definitely be thought-provoking. Thank you so much.
Thank you.